Hello ladies and gentlemen, and welcome to another video from Swaraj Finance. Today we're going to take a deep dive into the oil market and take a look at some charts around oil demand. So I've prepared this chart here, and what you can see on the top pane is the basically indicating the state of contango or backwardation in the oil futures market. So what does this mean for those that don't know? This basically is the difference, the spread in the price to purchase WTI crude oil, that's Western Texas Intermediate, the biggest and leading of all of the various types of crude oil markets out there, and it basically takes the spread between the price to purchase oil in the current month against the price to purchase oil next month. So normally we would expect a marginal spread. It should be slightly more expensive to purchase oil in the future, that is 1 month ahead, because of the cost to store that oil and deliver it at a date in the future. So that makes sense. If you're going to purchase it today, it's cheaper because you'll take delivery now. Whereas if you're going to ask someone to deliver it to you at a certain price in the future, naturally they're going to charge slightly more because they're guaranteeing you to store it and deliver it to you at that date in the future. So normally the future price minus the current price should be slightly positive, indicating that the market is in contango. However, when in certain circumstances, when there is high demand for crude oil now and people are worried and there's perhaps inventories of crude oil are going down, then it becomes more expensive to get it now than it is to get it in the future, 1 month. So people are not worried about getting it next month, they want it now, so they'll pay a premium to get it now. So this is when there's worries around the supply and there's high demand. And so that means that the spread goes negative, so it becomes more expensive to purchase it now relative to a month in advance. So on the top panel, what you can see is the red dotted line, dashed line is the zero level on that spread. So when it goes below, that means that the month ahead is now cheaper than the current month. So that means there's high demand to purchase oil now. When it goes above this line, what this means is that the market's in contango and it's more expensive to purchase oil in the future, as we'd normally expect. So more often than not, you can see that the level in this spread is above zero, and then at a few places it dips below, giving a signal that there's strong demand in the present. So if we take a look, going back to the great financial crisis, the global financial crisis of 2008, what we see is that there was a bull market in oil. So you see oil is here in the orange line below. There was a bull market, and then what happened is, because of inflation, markets were going up. There was this credit crunch where credit had become too easy to access, and we know about the subprime mortgage crisis. It was a credit crunch in the mortgage markets, which spread to other financial markets, and basically there was a crash, and then that also caused a recession. And in a recession, demand, people are worried about that demand is going to get destroyed. So I've put this DD, this demand destruction event occurs, and you see the oil market price collapse. So it went from I think it was over 120, say, all the way down to $40 a barrel. And so this was following a signal that had come slightly earlier in September of 2007, or even the summer of 2007 rather, where there was strong demand for oil and the market went into what we call backwardation, meaning it was more expensive to purchase oil in the present as compared to purchasing it in advance for a date in the future. So this demand signal came, the oil market, the futures market went into backwardation, saying that, look, we need more oil supply to come online to bring us back into a state of contango. But then we had this demand destruction event. So what happened? The oil price collapses, and at the bottom, the yellow line, what we see is the number of oil rigs, and this is aggregate of the main oil producing nations, the US, Iran, Venezuela, Saudi Arabia, so on and so forth. So you see the oil rigs, the number of oil rigs, active oil rigs, collapses because price goes down. So no one wants to keep the rigs running, producing oil, when you're not going to get a price for that oil which is going to cover your costs for running the oil rigs. So the oil rigs collapse. But we just had a demand signal showing that, look, we need more supply to come on. So rigs went down because the price of oil had collapsed in this recessionary environment. The spread between the futures contracts went into contango, so extremely into contango. So it was $4 more expensive to buy oil in the future because there was no demand for oil in the present in this recession scenario. However, as we saw, there was fundamentally a lack of supply that was signaled in the market slightly earlier, and so demand naturally picked up and the spread went back down, and you see the number of oil rigs, active oil rigs, started to increase, and then they well above 2,000, I think 2,200 rigs we see, and they stayed a high number of rigs for several years. So it ramped up from 2009 to 2011, and we see the level of high number of rigs being active up until 2014. And this was really led by the US and the shale oil, the Permian Basin in America, and the shale industry, onshore fracking and so on, where they ramped up heavily in the US to take advantage. And so prices went back up, stayed high, all the rigs were profitable, enough supply came online to eventually create too much oil supply relative to the demand. And so during this period we see that eventually in 2015 we had a signal saying, look, there's too much oil. We went strongly into contango, and it was over $2 a barrel spread between the forward month and the current month. And then we had 4 years of downward trend in the oil price. Number of rigs collapsed, went back down, never came back up to the same levels, and that was a period in which demand was coming offline. Supply was coming offline. As you see the number of rigs going down. Then in 2015, 2018, summer of 2018, again we see a signal for higher demand, because by now we'd had a few years in which the number of rigs had been significantly lower, meaning less supply. Oil price had started to pick up gradually from the bottom in 2016 of around $40 up to about $70 in the summer of 2018. So you had this demand signal coming, and oil price was rising. Number of rigs that gradually started to go up, but didn't hit the same level that we had previously had in the shale boom of the 2012, 2013, 2014 period. So this demand signal came on 2018, but then we had another demand destruction event, worries about a recession because of the raising of interest rates that created some worry in the financial markets, and then this kind of ended up rolling into what was the COVID crisis, which was a crash in March, April of 2020. And this was led to the global lockdown policy, and obviously a huge spike between the spread of the oil front and forward months in WTI because of the worries about no demand. Everyone's being stuck at home, no traveling, no international flights, or heavily reduced international flights, and so on and so forth. So we had oversupply and lack of demand again. If we look at the bottom, the number of rigs collapsed to one of the lowest levels that we've seen for a long in history, I think, to below 500 here. And then this was, however, following the period in which we'd just seen a couple of years earlier a signal that demand was increasing, but we had a demand destruction event, the COVID crisis, and a brief recession. But then oil prices, as you can see, rapidly recovered as people realized that, okay, we've shut down the whole world, but the demand for oil only basically went down by, I think, less than 15%, which is nowhere near what people thought. But the number of rigs had collapsed, so there was not being enough supply brought online. So the oil price rapidly recovered all the way from hitting zero, actually, all the way up to over 130, I think it was. And so the number of active rigs started to gradually pick up, but nowhere near levels that we've seen in history, meaning supply is not really coming online in a big way. So the market then subsequently went into backwardation, meaning there was such strong demand as the lockdown policies eased and international flights started to recover in 2021, start of 2022, that we had a level of backwardation that we'd not seen, an extended period of backwardation in the oil futures markets that we haven't seen for a long time, and deep level of backwardation, indicating this strength of demand and lack of supply. And so what we'd expect to see is a ramping up of the number of oil rigs, which has happened, but not to very high levels. So the oil price in the meantime went up to well over $100 a barrel. But since worries of demand destruction have come back into the markets, worried of a recession, the oil price has moderated and pulled all the way back down to around $60 a barrel. I think we're currently about 70. So there are worries about this demand destruction occurring, but if we lock down the whole world and we only saw 14% reduction in demand for oil and oil products, a recession that we might be facing will probably not do that much to oil demand, and we've seen that not much supply has come online based on the number of active oil rigs globally. So prices pull back because of these fears, but I would anticipate that they need to go higher, and more rigs need to be brought online. So the price is a signal. When people see that, okay, demand has not reduced that much, supply is not come online, price starts to go up to signal to oil producers and explorers, bring online more oil rigs, such that the demand supply deficit gets corrected. So that's what potentially we see happening. And if you look at the historical time that it takes for this to occur, so you saw, if we go back to the first example in 2007 is when this backwardation signal came, late in the last quarter of 2007. It took 6.5 years before for all of these oil rigs to come online and stay at a high level to produce enough supply to then to cover the deficit. So the time that it takes for price signals to come into the market, oil producers to respond to those price signals, the oil services companies to go in, set up the oil rigs, do the drilling, bring online more rigs. It's a cycle of at least 6 years. So we had 6.5 years. Then we had this 4-year downturn when there was too much supply of oil and relative to demand, and then that started to come down and we went back into backwardation, giving another demand signal. And now that was in 2018. So if we take 6.5 years from 2018, we'd expect end of 2024, start of 2025 as being the next point at which we might have a supply coming online to meet the demand and a turn down in oil demand relative to supply from that point onwards, and a downward movement in prices. But we really haven't seen oil supply coming on in the way that we saw it ramp up in the past for various reasons. I think worries over recessions and an oil price. The oil price is not really incentivized. If oil was, $60 a barrel in 2006, and we've had over a decade of money printing and inflation, then why is oil still hovering around, $60-$70 a barrel in 2023? It's more than 15 years later. Oil should be significantly more expensive based on the just general inflation. More money is around. There's more people in the world. The developing economies, India, China, and Africa, South America, parts of South America, those nations have increased their demand for oil and oil products per capita based on the rate at which those nations are becoming more consumption-based economies like the Western economies. So we haven't seen the supply come online. Price is not really incentivizing more supply to come online. So potentially this cycle of 6.5 years could take even longer than we've seen in the past, because of the COVID lockdowns, because of a lack of and I think another point to mention is the ESG policies and narratives around the environment, the climate crisis, and so on. So there's a reluctance to really invest in the fossil fuels, but it's important to remember that despite decades of transitioning towards renewable sources of energy, I think we've gone from 86% of global energy being fossil fuels to maybe 84%. So all of this wind, solar, and other sources of renewable energy, which have come online, have only over decades has only really marginally reduced the amount of fossil fuels that we need, because I think ultimately we probably will never be able to move away from fossil fuels, and that's a realization which some people might find it hard to digest, but I think it's we have to be realistic. And so given that the populations increase, and given that nations like India and Africa and South America will only be using more and more oil per capita as they develop into more consumption-based economies, demand will remain resilient and strong and increasing in the future, but we need to see supply coming online, which it hasn't. And so I think we're going to see higher prices for longer, and potentially this current cycle in oil could last more than 6.5 years. But certainly, based on history, we'd expect some sort of supply response to gradually come into play, but we need higher oil prices for that to happen in the short term. So we have a rough timeline of the start of 2025 potentially being a target for when we see oil. We should be seeing significantly higher oil prices by then. But like I said, it could take significantly longer this cycle because of the narratives and the change in attitudes in relation to fossil fuels relative to the first decade, the early 2000s. Just some thoughts to ponder, really, something that I was thinking about. And last thing to mention is the turquoise line, which the three charts at the bottom, as you can see, are fairly highly correlated. The bottom is the oil rigs, active oil rigs. The middle orange line is the oil price, and the turquoise is the oil sector of the equity markets. So the oil producers, the energy sector. So we've seen a strong upward move in the equities, but I think once we see the next phase of this current cycle turning up, I think there's significant gains to be had in the energy sector. And this is also in line with what happens historically. So in the middle of the last bull cycle for oil, we saw a kind of correction in the oil price and some sideways movement. Same in the equities before continuing to go up towards the end of the cycle. So that's probably what's occurring at this stage before we continue the move onwards and upwards. And a last thing to mention is this downward trend that I've also highlighted in the spreads between the front and the forward month in the futures market for oil, where you can see lower lows. So every time we go into backwardation, we're having stronger backwardation because of this. This basically corresponds to the number of active oil rigs. So in the past, when we've had demand, supply came online in a big way and for a sustained period. And since then, supply has not, active oil rigs has never reached the same level. So every time we're getting lower and lower number of rigs coming online to respond to demand signals, meaning that the demand signals become deeper and deeper. So every time we have backwardation, we're seeing these deeper spikes in backwardation. And although we've had this normalization in this spread from summer of last year, 2022, to spring of this year, that's a spread of $2 to almost $3, which was normalized to go back into contango. It just marginally went into contango above zero, and now we're heading probably back into backwardation again. So there's this downward trend in the spread also, where the highs, apart from this spike here, which was an abnormal scenario with exceptional circumstances of the global lockdowns and the fears that came in that. Generally, you've seen this downward trend as the number of active oil rigs has remained gradually got lower and lower and lower. So let's see what happens. But it means that there's a structural problem, at least going back over the last 10-15 years, where supply is not really responding in the way that we would expect to demand. And so although rising oil prices tend to respond to these demand signals, the number of oil rigs brought online has not really responded as it has done in the past. So I think that means we're going to see higher oil prices and bigger profits for the energy companies that are operating the existing oil rigs, meaning there's I think significant opportunities in the energy sector. If anyone's interested in ideas about how to potentially partake in the current oil cycle and which companies we like at Swaraj Finance, you can become a member on our website. You'll find a link for that in the description below, and you'll get full access to our model portfolio, which has a significant exposure to the energy sector. Nothing in this video should be construed as financial advice or a recommendation to buy or sell any investment. Obviously, you have to do your own research also. This is just some ideas, some analysis based on the financial markets and the data that we're looking at. So I hope you've enjoyed. Please like and share the video with anyone you think might be interested. And do subscribe to the channel. And we'll hopefully bring you some more interesting charts and analysis in another video soon. In the meantime, take care.